What happens when you try to turn your life insurance into a wealth-building investment? Spoiler alert, you get terrible insurance and terrible returns. And the data actually proves it. According to the IRDAI, nearly half of all traditional life insurance policies in India are abandoned within just 5 years. Millions of people buy these all-in-one plans, realize the returns are basically a joke, and then lose their money to massive penalties just to escape the trap. Hey everyone, I'm Ray. Today we are tearing down the biggest financial illusions sold to our generation, mixing your investments with your insurance. We're going to run the exact math on Rohit, who falls for the ultimate bundle trap, versus Kyra, who completely separates her risk protection from her wealth building. And by doing that, she secures over 2.6 crores on the exact same budget as Rohit. And ironically, understanding exactly why Rohit's bundled investment was doomed from the start begins with a trip to the supermarket. What? You know those massive, brightly colored bottles of 2-in-1 shampoo plus conditioner in the supermarket? The ones that promise to magically cleanse and moisturize your hair at the exact same time? Sounds like the ultimate convenience, right? Why buy 2 bottles when one does it all? But if you ask an actual cosmetic chemist, they'll tell you it's a structural compromise. The cleansing agents open your hair cuticles to strip away oil and dirt, while the conditioner tries to coat those same cuticles to lock moisture in. So basically, the chemicals are physically fighting each other inside the bottle. You sacrifice the power of both just to save 60 seconds in the shower. And guys, that exact same convenience trap is quietly ruining our generation's financial future. Welcome to today's deep dive. I'm Ray, and we are pulling out all the receipts, actual brochures from real bank data. We are deconstructing what the finance nerds call the hybrid trap, so you don't fall for it. Today we are settling the ultimate Gen Z debate, term insurance versus endowment plans, or as I like to call it, the math behind separating your money versus buying that 2-in-1 financial shampoo. Because the Indian market is absolutely saturated with these hybrid products. We've all been cornered in our living rooms by that friendly neighborhood uncle, right? The one who insists that putting money into an endowment plan is the only safe way to secure your future. But true safety? That's about autonomy. The ability to just walk away from a toxic workplace and live life on your terms. And building that kind of freedom means your money needs to be deployed with ruthless efficiency. So let's talk about our 2 hypothetical professionals, Rohit and Kyra. They are both 25 years old, scrolling through reels, ordering too much food on UPI. You know the vibe. And they both have a budget of exactly 1 lakh rupees a year to build their financial foundations. Rohit sits down with a very persuasive insurance agent who pitches him the golden lockbox, a traditional endowment plan. It promises a guaranteed maturity payout plus life cover, the ultimate bundle. Rohit is sold. He commits his entire 1 lakh annual budget for the next 20 years. And in return, he gets a life cover of just 15 lakhs. Just 15 lakhs! The inefficiency is actually staggering. It's a terrible transfer of risk. To understand why, you have to look under the hood. When Rohit hands over his 1 lakh, it doesn't go straight into a high-growth investment. It gets chopped up into 3 slices. Slice 1, the mortality charge, the actual cost of insuring his life, totally fair. Slice 2, the insurance company's internal admin and management fees. Okay, sure, but that third slice? That is the agent's commission. And prepare yourselves. Documents show agent commissions can eat up to 35% of your very first year's premium. So 35,000 rupees vanishes instantly into the agent's pocket. It never even enters the market. That money is compounding, all right? Just for the agent's current lifestyle, not Rohit's future. And the money left over? Because the company promised Rohit a guaranteed payout, they can't legally take risks with it. They are forced to park it in ultra-safe government bonds. Historically, those give a return hovering around 5 to 5.5%. Now, a guarantee sounds like a warm hug after watching crypto markets absolutely melt down. But when real inflation in India is running at 6 or 7%, a 5.5% return means your money is fundamentally shrinking. It is a mathematical guarantee that Rohit will become poorer in real terms over 20 years. So what does Kyra do differently? Kyra completely rejects the 2-in-1 shampoo. Instead of combining chemicals, she separates her risk protection from her wealth building. She builds a concrete vault. She buys a pure term insurance plan. Out of her 1 lakh budget, she spends just 15,000 rupees a year on this term plan. And what does she get for that 15,000? A massive life cover of 2 crores. Calculate your human life value, usually 15 to 20 times your income, and buy that term plan while you are young and statistically healthy. That's literally less than your daily cutting chai at the local tapri to protect your family's entire future. Why is it so cheap? Because it's purely statistical. Actuaries know a healthy 25-year-old probably won't pass away anytime soon. But here comes Rohit's favorite comeback. He looks at Kyra's pure term plan and laughs. But Kyra, if you survive the 20 years, you get 0 rupees back. It's money down the drain. Guys, this is the biggest mental block we have. We hate not getting a refund. But term insurance is not an investment. It is an expense, a small fee for peace of mind. Think about your car insurance. You pay the premium every year to protect against the absolute worst-case scenarios, right? If you reach the end of the year without crashing, do you call the company demanding a refund? No. You consider it a great year. The premium bought you safety. In Kyra's case, paying that 15,000 fee buys her the freedom to take aggressive risks with her remaining 85,000 rupees. She channels all of it into diversified equity mutual funds, a monthly SIP of about 7,000 rupees. Her money isn't dragged down by agent commissions or admin fees. Every single rupee goes into the market, targeting historical equity returns, which in India have reliably compounded at 12 to 15% over the long term. But Ray, you say, spreadsheets are perfect. Real life is messy. I hear you. Let's do a stress test. Fast forward 5 years. The economy tanks. Both Rohit and Kyra lose their jobs. Severe liquidity crisis. Rohit literally cannot afford his 1 lakh premium. He contacts the company to either pause or surrender his policy, and bam! He hits a wall of brutal, punitive surrender penalties. Remember that 35% the agent took? The company relies on your decades of payments to finally turn a profit. So, to avoid losing all the capital he already sank in, Rohit is literally forced to take out a high-interest personal loan just to pay his premium. His pursuit of a safe, guaranteed future structurally forced him into debt during a personal crisis. Meanwhile, let's look at Kyra. She opens her investment app and she simply taps Pause SIP. Penalty fees? 0. Her money just keeps compounding in the background. And scraping together 15,000 for her term plan for the entire year? Highly achievable, even in a financial crunch. This structural agility is the foundation of Gen Z autonomy. You need systems that can pivot when your life pivots. Now let's follow this to year 20. The grim hypothetical. Both Rohit and Kyra pass away in a tragic accident. Rohit's family gets the guaranteed payout, exactly 15 lakhs. After 20 years of inflation, that purchasing power is decimated. Kyra's family? They file the claim and receive the 2 crore sum assured entirely tax-free. But the wealth transfer doesn't end there. Her family also inherits her accumulated mutual fund corpus. That 85,000 a year, compounded at a conservative 12%, grew to about 68.5 lakhs. So Kyra's family gets over 2.6 crores. Rohit's family gets 15 lakhs. And they both spent the exact same 1 lakh a year. Now agents will deploy their ultimate scare tactic. They'll tell you, term plans are a mirage. They'll find a loophole to reject your claim. That narrative relies entirely on fear, not legal reality. Under Section 45 of the Insurance Act, once a policy has been running for 5 years, the insurer legally cannot reject a death claim unless they prove active, deliberate criminal fraud in a court of law. Kyra's vault is armored by statutory law. But Ray, the taxes, the traditional pitch screams. Endowments are tax-free. Yes, Kyra will pay a 12.5% long-term capital gains tax on her mutual fund gains. But let me ask you this. Would you rather give up 12.5% of a massive, juicy watermelon or keep 100% of a tiny, shriveled grape? Because that's what a 5% tax-free return is, a grape. The optimal strategy is absolute separation. Buy a pure term plan to handle your risk and invest the rest in the market. Calculate your human life value, usually 15 to 20 times your income, and buy that term plan while you are young and statistically healthy. If our generation wakes up and entirely stops buying these inefficient hybrid traps, it starves the most profitable mechanisms of a legacy financial empire. And honestly, that's kind of a flex. Just a quick reminder before we wrap up. We aren't a consultancy or agency here, just an educational platform sharing the basics of finance. Stay smart, stay autonomous, and I'll see you in the next deep dive. The legacy finance industry literally banks on us staying confused. If this helped you dodge the trap, hit subscribe and drop a comment below. I want to read all your stories. Also, drop a like and share this with that one friend who's about to buy a 2-in-1 shampoo or a terrible insurance policy. You might actually save them lakhs. Make sure to follow us across our platforms for more zero-jargon financial education. I'm Ray, stay autonomous, and I'll see you in the next one.